Yeah, hello. Very good afternoon to one and all. I hope you enjoyed the previous class. Today we are going to discuss the second class, or the first unit, second chapter, that is the national income accounting. Right. So the chapter which we are referred, the book of Abel Bernanke. So this is the Abel Bernanke Crochet book, Macroeconomics. Right. So we are discussing today's class that first the measurement and structure of the national income. Right. So generally, what is the measurement and what is the national income? Right. Measurement is a crucial part of scientific study. Right? Whatever it is, we can measure how it is, whether sometimes it is increasing, decreasing, stagnant. So we have to measure of the variable, macroeconomic variable, according to measurement or some methods. Right. So here we are discussing about the macroeconomy, particularly Indian economy. What is the national income and the concept of national income, right? So how you can define the national income in the country, and after that, how you can measure and methods of the calculating national income, right? So before going to discuss this measurement of the national income, first we need to understand the fundamental concepts. What is the fundamental concept? What is the national income? Right. After that, we know that how you can calculate it, how you can measure national income, and so on. Right. In that purpose, I just share one screen. This is the one which is the basic national income concept in India and the measurement of national income. Right. So first we need to know that what is the national income. Right. So what is the national income? Simply say national income. National income is sum of the all the income. Simply say national income is the sum of the all the income of the country. Simple words. But in economic terms, which we are understanding that national income is the money value of all the final goods and services produced by a country during a particular period of time or 1 year. Because here we can say that 1 year. 1 year means we are always academic year. So March 31st to April 1st is the some national economic year. Actually, you can say academic year, which is not academic. You can say that accounting year, right? National income accounting year month is 31st March to 1st April. So between that particular period, suppose example in this present, in this 2022. Right, what is the national income is? In that case, we have to understand that national income 2021, right? This 2022 March, we are in the May, right? So we are calculated that national income on 2022, right? 31st March to 2022 to next April 1st, 2023. So between the period, what is the national income is? That is, you can calculate all the money value of final goods and services produced in a country. Right. So coming to, since these are the goods measured in different physical units, not in the possible to add them together. Suppose again I can say that you can say there are different concepts of the national income. Now, basic concept of national income. What is the basic concept? Gross domestic product. Right. And gross domestic product, sometimes you can measure, you can understand that gross domestic product at constant price and current price, gross domestic product at factor cost, gross domestic product at market price. So national income is divided into four different concepts. One is GDP, gross domestic product. Another one is NDP, net national product. Another one is GNP, gross national product. Another one is NNP, net national product. So here, sometimes we are calculated GDP or gross domestic product constant price and current price. Sometimes factor cost, sometimes market price. Okay. So what is the constant price? What is the current price? Constant price is, we are calculated the GDP on the basis of, right, base year of the national income. Base year means there is a year which we are government has to do, base year have to prepare. According to that prices, you can calculate the domestic product, the gross domestic product. So earlier, what is the national income base year? 2004 and 5. At present, the base year is 2011 and 12. Got it? So according to 2011 and 12 prices, you can calculate all the goods and services, final market value of goods and services within a particular period of time. That is, you can call as constant price GDP or GDP at constant price. So if you are calculated on the basis of current prices means 2022, the price of the goods and services is some amount. According to that current prices, you can calculate the GDP, that is GDP at current price. In all the concept, GDP, GNP, NDP, NNP, all are we are calculated on the basis of sometime base year, sometime current year. If you are calculated current year, 2022, according to the price, that is the GDP current price. According to base price, you can say that constant price. Right. Next, coming to another differentiation is, right, gross domestic product at factor cost. What is this? Gross domestic product at factor cost and the market price. So factor cost means after production of the goods and services. That means whenever we are using the factors of production are land, labor, capital, organization, right? So we are the households actually. There are two sectors in economy. Okay, circular flow diagram which we are discussing later. First, there are two sectors in the economy: household sector that we are. We are the owners of the factors of productions, right? And the farm sector. Another sector is the farm sector. One household sector. Another one is farm sector. Household sector has to provide the goods, these factors of production. The farm sector has to utilize the factors of production to produce the goods and services. So, after they produce the goods and services, we are calculated as a national income or gross domestic product. So, at the time of the process of the production, or in the process of the production which we are produced, so we are getting some kind of subsidies from the government, like subsidies like land, investment, any loan, whatever it is, the things, subsidies which we are right collected or getting from the government. So subsidies are including, okay, at the case of at the case of factor cost. Okay, subsidies are including whatever other one IT. What is that IT? Indirect taxes. So at the time of the production, which after production of the goods and services, because we are getting the subsidies, we are producing the goods and services, we are utilizing the infrastructure in the country, we have to pay the tax. That is indirect tax. Indirect tax is different sources. One is the income tax and the corporate tax and so on. So we have to pay the tax. That is indirect taxes. So indirect taxes must have to pay so that you can exclude at the time of factor cost. Okay. So factor cost minus IT plus subsidy. Got it? In the case of gross domestic product at factor cost minus IT plus subsidy. But in the case of gross domestic product at market price, in the market price, we already pay the tax. So that market price means what? The price is available at the market at the level of the price. That is the market price. The final product, that is where we are produced in the market after production of the goods and services. If we are calculated on the basis of the market price, the GDP, we have to include subsidies because we are already getting the subsidies from the government. That is included. What we are exclude, we already pay at the factor cost, that is the IT minus IT plus subsidy. So the GDP at market price, right, minus IT plus subsidy. At GDP at factor cost minus plus IT minus subsidy factor, right? So now you can look at what is the differences between factor cost and market price? IT minus subsidy. Okay. So if you want to know GDP at market price equals to, okay, so C plus I plus G plus, right, IT minus subsidy. That is the market price. If we are talking about gross domestic product at factor cost, the GDP at market price minus subsidy, sorry, minus IT plus subsidy. That is factor cost. So this is the differences naturally. Okay. Next concept is gross domestic product. Sorry, net domestic product. Previous one we are discussing gross domestic product, right? Within the gross domestic product, we are discussing different types of the gross domestic product: constant price, current price, and after the factor cost, and after the market price, right? Now, net domestic product. Net domestic product which we are getting, right, from the gross domestic product. In the process of the production, which we are using the factors of production, there is a depreciation will taking place. That means whatever the raw material which we are using and infrastructure which we are using, there is a depreciation will taking place at the time of the process of the goods and services. So dear students, at the time of process of the goods and services, there is a depreciation will taking place. You have to reduce or you have to exclude the depreciation from the gross national product. So NDP equals to GDP minus depreciation, so that you can get the net domestic product. Got it? That is the domestic country income, GDP and NDP. Got it? So gross versus net, differences is depreciation. Okay. Here how you can get it the equation, but here I think board is maybe next class I will use the board. At that time I can explain you. Okay. So just you can note out, right, what I am discussing here in this class. So NDP is equals to GDP minus depreciation. GDP what? Again equals to C plus I plus G plus, right, IT, sorry, minus D minus depreciation, sorry, GDP minus depreciation, right, C plus I plus G minus D, that is the NDP. Maybe you students are learning plus 2. Just I can recap that, you know, you understand that we have to recollect that concept, because this concept is very important to how to can measure the national income. Okay. Next, gross national product. Earlier gross domestic product. Now we are discussing gross national product. In the gross national product, there is a one NFIA, net factor income from abroad, is including from the gross domestic product. So gross national product is the market value of all final goods and services produced during a period of time within an accounting year, with including net factor income from abroad. Net factor income from abroad was NFIA. NFIA. What is that? Factor payments received from the rest of the country, the payment which we are paying to the rest of the country. So payments minus receipt, that is the NFIA. So GNP is gross national product is equals to GDP plus NFIA, net factor income from abroad. That means receipts and payments. Okay, clear? Gross national product. Coming to the net national product. Net national product is the one concept, very important concept, which you understand, that the national income concept. Okay, what is the how you can get the net national product? You can get the net national product from gross national product. Okay, gross versus net. The differences between gross and net, whatever discussing earlier, same. That is the depreciation. Okay, GNP minus depreciation, that net national product. Got it? So GNP means, so GDP minus depreciation, right? So that is the NDP, right? So here GNP minus depreciation, NNP, net national product. Okay, GNP means C plus I plus G plus NFIA minus depreciation, that you can call it net national product. But this is not a national income. We have to calculate it, the factor cost or factor cost net national product. So in the case of net national product, factor cost is equals to, what is the factor cost? Minus IT plus subsidy. Just added that minus IT plus subsidy from net national product, so that you can call as net national product of factor cost. That is also you can call it national product. So how you can write it in equation? So NNP at factor cost is equals to C plus I plus G plus NFIA minus depreciation, right? Minus IT plus subsidy. That is you can call as national income. So what we are understanding, national income is net national product at factor cost. So you can also call it as net national product of factor cost is also called as national income. Okay, so this is gross domestic product we already discussed. Okay, so there is no need to discuss this. And yeah, this is the equation what we are discussing actually. Got it? So look at here, GDP factor cost and GDP at market price. So GDP factor cost is equal to GDP minus IT plus subsidy. So this is GDP factor cost. Okay, market price you can get it. GDP MP equals to, right, C plus I plus G plus IT minus subsidy. Market price there is included, right? So that we are discussing. Next. So NNP is GNP minus depreciation. Whatever we are discussing, same. GDP plus NFI, GNP, gross national product, right? And NNP, and down here we can look at NNP plus, NNP is equal to GNP minus depreciation. Got it? I hope you follow my class, right? Yeah. If you have any comments, any doubt, please question and answers. Last 10 minutes we are taking the question and answer chart, so that we can clarify the doubts, right? So now we are going to discuss another concept that right, other important concept of the national income are. So here you can look at it. So what are we are discussing? NNP factor cost is equal to national income. That is, so C plus I plus G and so on. I plus G plus NFIA minus depreciation plus IT minus subsidy. Okay. Another concept of the national incomes are, so these are the concepts: personal income and disposable income. What is the personal income and what is the disposable income? So these are all personal income and disposable income are two concepts of national income, very commonly used in advanced countries. So personal income may be defined as the current income of the persons and households from all services. So current income is whatever we earn on the basis of the labor wages. We can get some salaries, we can get some other sources. Whatever you get, that is your personal income. Okay. So personal income is not a measure of the production. That is not a production, right? What about other income? Disposable income. So all personal income is not disposable to spend on consumption, because after you getting the income, you must have to spending. You must have to consume of the goods and services. After that, whatever you are received the income, you have to spending, and you have to pay some taxes to the government. Okay, suppose example, you are a salary employee, or salary you can get it somewhere in some institutional organization. So that after you can receive your income, you have to pay the taxes as well. That is personal taxes, direct taxes, sometimes indirect taxes. So after you receive the income, you have to pay the taxes. That is direct taxes. After you pay the direct taxes, that you can call it disposable income. So in the down, you can observe DPI, that is disposable income, is equal to personal income minus personal direct taxes. That is disposable income. Okay. So and disposable income minus saving also you can say. Okay. Sometimes you can say real income and nominal income. How you can calculate the real income and nominal income? So to find out the real income of the economy, according to the base year is selected. What is the base year? We already discussed. 2011 and 12 prices, that is the price index. Okay. So the price level that year is assumed to be 100, right? So money income, whatever the real income is available, income upon the price index multiplied 100. So that is you can real income. You can get the real income. Okay. So what about nominal income? Here it is not mentioned. Nominal income is equal to right. Real income multiplied price index. Real income multiplied price index, that is you can get the nominal income. Okay. Some fundamental concept which you are learning. Okay. Now After we learn another important concept, I forget it. Per capita income. Maybe you students have learned the previous classes, that plus 1 plus 2 level. So per capita income is right, national income upon by right total population. You can calculate the per capita income, national income upon by what is the total population, right? So that is per capita income. Maybe sometimes it is calculator, it is useful for any competitive exam or further purpose. Okay, purpose of any exam. So now we are going to discuss in our basic concept is what are the measures to measure the national income, right? So generally there are three methods which we are discussing to calculate the national income on the basis of census of the production method, on the basis of the flow of the product, you can call it the product method, as a flow of income, that is the income method, as a flow of expenditure, you can call it the expenditure method. That means there are three methods which we are calculated the national income. What is the methods? One is the product method, another one is income method, another one is expenditure method. So this is the product method. Suppose in this case, we have this PPT that right. So Abel Bernanke book. So maybe this PDF is available. If it is possible at the end of the class, let's say I will share this PDF. Right? But for this one first unit purpose, we have to refer this book, Abel Bernanke Professor book, Macroeconomics. This is the title of the book. Okay. So here we are that book which we are. You must have to follow this book actually. In this case, we have to easy to understand that. Okay. So in the case of national income accounting, there are three methods to measure the national income. That is the product method, income method, and expenditure method. Okay. So now we are going to discuss about the product approach. This is the product approach, right? Suppose you can discuss in here product approach and income approach, and the three approaches which we are discussing. Expenditure approach. Okay, yeah, this is the one first which we are discussing. So this is the gross domestic product which we are already discussed, that different concept of the national income. So how you can measure national income or the GDP according to the product approach. Okay, so here the product approach is the one broader measure of the aggregate economic activity. It is well known that the gross domestic product or the GDP. Okay, we already discussed that GDP is gross domestic product, the market value of all final goods and services produced within a country. So GDP may be measured. See, look at here. GDP may be measured by the product approach, expenditure approach, and income approach. Now we are going to discuss detail in each and every product. Now coming to what is the product approach to measuring the GDP, right? So dear students, the product approach is defined nation's gross domestic product as the market value of final goods and services newly produced within a nation during a fixed period of time. So this is actually exactly the term of economic term of the GDP, according to the product approach. Got it? See, look at it. Here, newly produced within a nation during fixed period of time. Just point out that. This is the common, all market value of final goods and services. It is common in each and every product and each and every measure and each and every concept. But here, according to the product method, we are calculated this GDP newly produced within a nation during a fixed period of time. Newly product means the final value, not in some other value. That is the intermediate value, right? And during a fixed period of time means there is a economic year. National economic year is 31st to 1st February. Okay, that production which we have calculated and measured the national product according to the product approach. Look at here. This is the product approach. Product approach means only we are calculated only production goods and services in the economy. Okay, so look at here. So first, in this definition, we are discussing different concepts actually. What we are including, what we are not, right? What we are excluding, and so on. So goods and services are counted in GDP at their market values. That is, at the price at which they are sold. That is market price. Got it, dear students? We are understanding that the GDP which we are calculated on the basis of market value. That market value means at the price at which they are sold. Producer. Okay. The advantage of using market values is that it allows adding the production of different goods and services. Look at allows adding the production of different goods and services. Adding the production of different goods and services means in an economy there are different sectors of the production of the goods and services. Like example which we are discussing, agriculture sector, service sector, and industrial sector, which we are calculated all the different subsectors to addition to all of the particular production. So sum of all these production of the goods and services at market value. That is, you can calculate it gross domestic product at market value. Okay, this is you can understand. Next, coming to this value, newly produced goods and services. This is the new concept which we are adding in the definition in according to this product approach. What is this? As a measure of current economic activity, GDP includes only goods and services that are newly produced within the current period. So, example, if you are using all the raw materials of one mobile raw materials. One is the battery, another one the SIM, another one is the some camera, another different raw materials which we are using to produce the mobiles, right? So all these raw materials are not newly produced. That is not a final goods and services. You can say, what is the newly produced goods and services? Whatever the mobile is at the time of the market. So whenever you're using that for mobile, that is the final new market, new product. That is only you can calculate it according to the GDP. Right? So GDP excludes purchases and sales of the goods that we have produced in the previous periods. Excludes and includes. Excludes means whatever you have purchased the previous year, sales of goods and services, that is not to counted in this year. That is most important. That's why newly. The previous year, that means suppose example, we are calculated current GDP, that means 2022 GDP, only we are calculated 31st March to next year, April 1st, what is the national income? That is only we are calculated. We cannot calculate it 21 April, 21 February, 21 August and all. We cannot count it that. That is not a newly. The activity which were happened previous year, that is not counted at present GDP. Only we are calculated whatever newly produced between the period, whatever it is produced, that only you can calculate it. That is the newly produced goods and services. Next, final goods and services produced in the economy. So sometimes we are the differentiation between final goods and services and intermediate goods and services. We are discussing. In the national income, we are calculating only the final goods and services. We cannot including intermediary goods. What is the intermediary good? Intermediate goods and services are those goods used up in the production of other goods and services in the same period that they themselves were produced. Intermediate goods. Okay. So intermediate goods are the goods that themselves they can produce. They cannot produce other productions. Okay. So whatever the final goods and services, the final goods and services are the goods during the period of time may be classified either intermediate final goods are the goods which are not intermediate. That is at the end of the process of the production. So raw materials like mobile, charger, mobile, within the parts of the different raw materials, that is not a final goods and services. What is the final good? Mobile is the final good. The same thing, whatever we are produced any goods and services like agriculture product like wheat. Wheat is the final production, right? So whatever the raw material, the seeds, pesticide, soil, subsidies, whatever you see, whatever it is you are using, all are the raw material. That is not a final good. Final that is the intermediate good. Intermediate goods are the goods the time period that they themselves were produced. But at the time of the production is that is the wheat. Wheat is the final production. That is only we are calculated, not in intermediate goods. So we are calculated on the production method only final goods and services that is newly produced. So that's why this definition is beautiful. After we differentiate between what is the market value, what is the newly produced value, newly produced product. So according to that, you can calculate the gross domestic product. Okay. Next, coming to gross domestic product and gross national product. We are already discussed that gross domestic product and gross national product. The difference is NFIA, net factor income from abroad. Okay. So gross national product is the market value of final goods and services. This is the point which we are. Okay, we are highlighted here. So this is the point which we are discussing. The gross national product is the market value of final goods and services newly produced by domestic factor of the production during current period where GDP is product taken within the country. So that means GNP is equals to GDP plus net factor income from abroad. What is that here? Net factor income from abroad is to be income paid to the domestic factors of the production by the rest of the world. What is the point? This is the economic term actually. Whatever earlier we discussed, that is the simple understanding. The factor payments, payments received, payment which are taking place. So here what income paid to the domestic factors of the production by the rest of the world. That is right. That is payments of the rest of the country, and income paid to the foreign factors production by the domestic economy. So income is paid to the foreign factors production so that you can receive from the So here look at GDP equals to GNP, what we are discussing earlier. This is the concept, right? Pink one. So GDP equals to GNP minus NFP, net factor income from abroad. So NFP is also called as, wherever we are discussing earlier, NFIA, net factor income from abroad. Both are same. Okay, NFP or NFI, NFIA. Got it? So finally, the GDP which we are calculated according to the product method, GNP minus net factor income from abroad from the all the processes, that market value of final goods and services produced within an accounting year. Okay, coming to second approach of the national income is to measure the GDP, that is expenditure approach. Okay, so a different perspective on the components of the GDP is obtained looking at the expenditure side of the national income accounts. What is the expenditure method? According to the expenditure approach, the measure the GDP as total spending on goods and services produced within a nation during a specific period of time. So this is the definition actually, according to this able Bernanke. What are the basic four categories of the spending of the GDP? There are four sectors of the expenditure. What is the four sector in the economy? We already discussed earlier. That is household sector, farm sector, government sector, foreign sector. So household sector, it represents C. Farm sector, it represents I. Government sector, it represents G. Foreign sector, it represents NX. So total income which we are measured, C plus I plus G plus NX. This is the one diagram. Actually, I'm supposed to write it board, but so maybe next time I can use the blackboard, right? So whiteboard you can use it, so that you can people are understanding easily. Okay, today's class just to go through like this. Okay, this is the equation actually. What is the income? National income y is equal to C plus I plus G NX. This is what only NX means exports and imports. Okay, national income. So GDP plus NX. That NX is also called NFIA. So GDP, all right, y is equal to GDP, that is total product method, total income method, expenditure method. So expenditure will taking place in four categories. What is that? C, consumption is also one expenditure. Investment I is also one expenditure. J, government purchase of goods and services also one expenditure. NX, net exports of goods and services also one component of the GDP of expenditure. So one of the basic, this is the equation, right? What is the equation? GDP. Either in terms of the expenditure approach or product approach or income approach, the equation is same. This is you can call as income identity, national income identity. Y is equal to C plus I plus G NX. Okay. So this equation 2.3, this is the one of the basic relationship in a macroeconomic equation. So this is you can call as income expenditure identity, because C, household expenditure, I, farm expenditure, J, government expenditure, NX, foreign expenditure. This is you can call as the income expenditure identity, because it states that Y is equals to total expenditure, C plus I plus G NX. Okay, here the US based example they are given because other is USA based other, so that they can give the example on basis of dollar value. Okay, suppose here, for example, you can understand that how you can measure the calculate the GDP on the basis of expenditure method. So see, this is what personal consumption expenditure, the household expenditure. Household expenditure. Sorry. So household expenditure means we are the consumers, right? We are consumed to getting a food, shelter, and all fundamental things which we are getting, and goods as well as the services also we can get. So in that case, we have to spend some income. That income is in terms of the dollar value or in terms of the rupees value, whatever it is, you can. So these are the rupees which are taking place. See the consumption, household consumption is $10,130, percentage 70%. And I, this is the farm sector. Farm sector means the farm sector has to put the investment on to produce the productions or businesses and some equipment and software, whatever it is. In different sector has expenditure showing like this. Next, even government also they can spending on the defense and nodal defense and state, local government expenditure. So this is the government expenditure. Net export is the one export of the goods and services, imports of the goods. And there is also some expenditure. So all of these, what is the expenditure? Y is equal to C plus I plus G and X. So in this case, we always discussing C, I, and S. What is this C? What is this investment? You can detail discuss in ISLM model, and also you can discuss in classical theory of income determination, King's theory of income determination, this consumption investment. But what is the consumption? We need to understand that. Consumption is spending by domestic household and final goods and services, including those products abroad. This is the economic term. Simply say, consumption means, right? So the spending on goods and services, right, by the consumer. Simply, the spending on goods and services by the household. We are the household, right? We are spending to getting goods and services. That is consumption you can call. Okay. So this is the one component of the GDP. Consumption expenditure is there are three categories actually. One of the basic component of the GDP is consumption. Consumption can divide in three categories. One is consumer durable goods, where the consumption will take place. Non-durable goods, another one is services. What are the consumer durable goods? Consumer durable goods are the goods which are long-lived consumer items, such as cars, television, furniture, major applications, and so on. Right? Mobile, laptop, these all are the consumer durable goods. What non-durable good? Non-durable goods are the goods, the shorter-lived items, such as food, cloth, PL. You cannot use again actually. Food, drink, and ice cream, whatever these are the goods, short-lived items. Vegetables, rice, wheat, these are the short-lived. Once you can utilize, you cannot recycle. So that you can call it non-durable. Durable goods are the goods that is long-lived consumer goods. Non-durable goods are the goods which is short-lived consumer goods. Right? Not only goods, we are also consume services. Services like education. Education is one service. Who is provide? Government provide the education. We are teachers are provide the education. Institutions or organizations provide the education. Healthcare is private and government sector provide. Financial services, service sector provide. Transportation, government, private sector also provide. These are the services also we are consuming. So consumption is the basic component of the GDP and also large component also you can say. Next, another important component is investment. Investment is also one component of the GDP according to expenditure method, out of the income method and all. So what is the investment? Investment include both spending new capital goods and that is you can call as fixed investment. Fixed investment, inventory investment. What is the fixed investment and what is the right? What is the fixed investment? What is the inventory investment? Fixed investment is the investment. It only has two major components: business fixed investment and residual investment. Business fixed investment and residual investment. Business fixed investment what? Which is spending business on structures, that is the factories, warehouse, office building, example, so on. Fundamental sources actually you can say, right? A vehicle, computer, furniture, right? So what about fixed, non-fixed, that you can call it residential investment, which is spending on construction of the new houses, apartment building, apartment building, and so on. So investment is there are two types of investment: fixed and residential investment. Okay, so this is some kind of part of the expenditure method components of the GDP. Next, the government purchases of goods and services. What is this government purchase of goods and services? Is identical expenditure by the government for a current produced goods and services. Foreign and domestic, the third major component of the expanding. Okay, what is the government spending purchases is? There is the transfer payments. What is the transfer payments? Transfer payments is the payments that the government payments for the social security schemes or medical benefits. Suppose the government has to give the public distribution system, rice and other water ration. And also the government has to provide the medical benefits. Like government hospitals has to provide the services that free medical benefits from all the people below poverty line population. What is the point? These all are the government purchases or government expenditure. Okay, whatever we have received from the government, that subsidies, or the transfer payment, benefits, medical benefits, or education benefits, that all are the government purchases. That is also part of component of the GDP. Okay, so this is one thing what we are discussing, the basic component of the expenditure method. The another important component of the expenditure method is net exports. So already we discussed that this net export, the goods and services produced within a country, they are purchased by the foreigners. Okay, so net exports is a positive. That means exports are greater than the imports. If it is negative, the exports negative. If imports exceeds to import. So this is sometimes the nation sometimes surplus, sometimes deficit which we are finding. Sometimes in newspaper you are observed that national physical deficit, physical right surplus. Same as here, national income deficit and surplus. Income deficit means whatever the imports is exceeds to exports. Imports more means we have to pay to the rest of the country. Exports more means we have to receive from the rest of the country. More export will always to better experience to the country to improve our economy surplus value. Okay, so this is what we are discussing up to expenditure approach. So first one is the product approach. Next one is that we are discussing about expenditure approach. We are discussing now. We are going to discuss about the income approach to the measuring GDP. What is the income approach? Whatever earlier we are discussing, that same components we are also here. The other third and final way measure of GDP is income approach. Income means how the income is circulated to one sector to another sector. How you can sum up all the income in the country. How you can measure? You can measure of all the sources of income. So national income is some of the 8 types of income. So that we are discussing here. Some of the 8 types of income. What are the different types of income? One is compensation of employees. What is the point? Who is the compensation of employees? The compensation of employees is the income of workers. Who is the workers? We are the salaries, right? Excluding self-employed, including wages, salaries, employee benefits, and other social security contributions. All are compensation of employees. Simply salaries which we are getting. Next, properties income. Properties income is another source of the non-corporate self-employed income. So this is also calculated on the basis of the national income approach. Next is rental income of the persons. Rental income of the person. So Delhi, you can observe that Delhi is the more income of the rental income of the persons. Generally, it is a small income compared to other income, but is the income earned by the individual who own a land structure that they lend to the others. They lend to the others. Some miscellaneous type of income, such as royalty income paid to the others, recording artists, others also including this category. So rental income of the person was about 1.5 in GDP according to 2008 reports. Okay. Next, corporate profits also part of the national income, which we are calculated the GDP. What is the corporate profit? Corporate profits are the profits earned by the corporations are the represent the remainder corporate revenue after wages, interest, rents, other costs have been paid. Okay, it represents corporate revenue after wages. Corporate revenue, whatever you receive the revenue after wages, interest, rents, and whatever it is. Right. So the rest of the corporate profit taxes divided called retained earnings and kept by corporate. Corporate profit generally there is 9.4% in GDP. This is also one part of the source of income method approach. Okay. What is the another source of income? So this is the example case study. Income approach, the method you can calculate it. These all are the components of the income sources. So compensation of employee, properties income, rental income person, corporate profit, net interest. So some of all these total income is national income that is equal to national income $12,635 billion value is the total income of the nation. Okay, in terms of the percentage, 87.5%. So some of all these you can count it here 87.5%. This is all the sum of the sources of the income. What are the sources? These are the sources which we are discussing, right? So if you are calculating what is the GDP according to that national income, so in that case you can calculate the NNP that equals to NNP product NNP how you can get plus statistical discrepancy. Statistical discrepancy you can add it 101 so that you can get it this. After NNP, net consumption of fixed capital, that is depreciation. Okay, NNP plus depreciation, NNP plus D depreciation, so GNP. GNP minus, right, GNP you can get it GDP, GNP minus depreciation. So GDP is equal to this. So this is what we are some example. Okay, what about other sources? Net interest also another source of the income, and net income interest rate. Okay, and taxes on production and imports are also another important concept. Taxes on production and imports. Okay, so this is also another source of the income, and business current transfer payments is also another source of income, and also current surplus of the government enterprises. This is also another source of income. So these are what the sources of all the income in the domestic country. Got it? So here you can look at according to the income approach. The income is private disposable income. How you can get this private disposable income? It measures the amount income private sector is available to spend. Okay, this is the private disposable income. I think so. This is the concept whatever we are discussing national income accounting. That is the national income concept and measurement of the national income. After that, which we are discussing saving and wealth. So I think so measure the whatever the saying. This is some fundamental concept. Okay, but one question maybe it will be fine in exam, right? That is the explain the national income. What are the measures to measure the national income? So these are the three methods which we are discussing. Okay, so now I stop the class now, and now I open the floor to can ask any question and answers. Okay, so Q&A, there is a reaction, any kind of questions which we are asked. So please ask me. Right? Please share here so that I can get the. Yeah. So if you have any doubts, so let me know. Susmita Kumari. Okay. Drop your message here, Chetan. Yeah. Question and answers. Yeah. Chat box. I saw some messages. And Chat is turned up. I think, ma'am, please open the chat box. Maybe students ask the questions. Hello. Organizers, please open the chat box, please. I think, yeah, Lakshita Suri, please unmute and you can ask me the question if you have any doubt. Are you people are hear my voice, right? The class was good. Question and answers, please. I think my side there is no options to allow to talk, but yeah, organizers, please allow to the students to ask the question and answers, please. Yeah, I couldn't get any chart actually, any question and answers. Hello. Hello. Yeah, I couldn't getting your voice actually. There is a dual communication. So there is a single communication only. I am only discussing with you, but I couldn't get your voice. The organizers must have to take this. Yes, Varun. I couldn't get your voice, please. Hello. Yeah. Hello. Organizers, please respond. Please do the needful. I couldn't get the student's voice. Yeah. Now you can allow talk to all the what's up. Please respond. What's up? What's up, Jaswal? Now you can mute yourself and yeah. Yes.
Hello, good evening, sir. Am I audible, sir?
Yes, yes, you are audible now. Tell me.
सर मेरे को बस ये पूछना था कि जो आप पढ़ा रहे हो उसके जो नोट्स होंगे वो कहाँ पे अवेलेबल हो सकते हैं?
हाँ बेटा, इसके लिए ना एक वेबसाइट है, ठीक है, दिल्ली यूनिवर्सिटी स्कूल ऑफ ओपन लर्निंग में क्लिक कर लीजिए ऑनलाइन में, वो आपको मिल
यस
जाएगा।
सर।
ठीक है,
तो सर वो मैंने देखा एक्चुअली वहाँ पे वो नोट्स ना वो इनवैलिड दिखा रहे हैं या तो मतलब कि वो दिखाई नहीं रहा
हाँ
सर।
एरर आ रहा है एक्चुअली। हाँ मैं भी ट्राई करता हूँ,
यस सर।
लेकिन के बाद कुछ टाइम के बाद आपको ना ट्राई कर लेना। मैं आपको दिखा रहा हूँ, यही है वेबसाइट, आपको स्क्रीन शेयर हो रहा है ना,
यस सर।
ये पुस्तक है ना,
यस सर।
ये वाला वेबसाइट है पुस्तक।
यस सर।
तो कुछ मे भी अभी कुछ टेक्निकल ग्लिचेस होगा, ये इसमें जाके होम में जाके ये पुस्तक पर, तो इसमें आप क्लिक कर लीजिए इंट्रोडक्टरी मैक्रोइकोनॉमिक्स, ये सारा सिलेबस आ जाएगा।
सर वन मोर थिंग वन मोर थिंग सर, यूनिट 4 में जो ये यूनिट है द क्लोज्ड इकोनॉमी इन द शॉर्ट रन है ना सर, सर उसके पहला चैप्टर का नाम आप बता दोगे क्योंकि एक्चुअली मेरे पास बुक है ना तो वो बुक में सब कुछ मिक्स्ड है तो आप प्लीज। हाँ जी सर।
चैप्टर इन्फ्लेशन, थर्ड चैप्टर इन्फ्लेशन।
तो सर इन्फ्लेशन तो यूनिट 3 का है ना सर?
हाँ यूनिट 3 इन्फ्लेशन है, यूनिट 4 क्लोज्ड इकोनॉमी, शॉर्ट रन क्लोज्ड।
हाँ सर, तो उसका पहला चैप्टर का नाम क्या होगा सर? क्लोज्ड इकोनॉमी इन द शॉर्ट रन का उसके लाइक चैप्टर्स बहुत सारे हैं तो आप बता दो कि पहला चैप्टर का नाम क्या होगा तो मैं वहां से स्टार्ट कर लूं।
क्लासिकल थ्योरी ऑफ इकोनॉमिक्स। या
क्लासिकल थ्योरी ऑफ इकोनॉमिक्स। सर एक चैप्टर है जो इन्फ्लेशन के बाद आ रहा है शॉर्ट रन करके, बस एक शॉर्ट रन करके है तो वो स्टार्ट कर सकता हूं सर?
वही शॉर्ट रन मतलब क्लासिकल थ्योरी ऑफ इनकम डिटरमिनेशन, राइट?
तो सर वो कर सकता हूं ना स्टार्ट?
हाँ वो आप कर सकते हो।
ओके सर, थैंक यू सर। थैंक यू सर।
I think there is a very less time, 2 minutes only. Mayank, yeah, say something if you unmute yourself. Yeah, Mayank. Mayank, you want to say? You have any doubt? Yeah. And Aditi,
सर।
yes please Aditi.
सर हमने जो लास्ट क्लास में सर आपने बस नॉर्मेटिव इकोनॉमिक्स की था, वो गलत यूनिट हमारा
फर्स्ट वाला यूनिट है हम लोग डिस्कस किया, वो इंट्रोडक्शन ऑफ मैक्रोइकोनॉमिक्स।
तो सर उसमें बस लास्ट टॉपिक नॉर्मेटिव इकोनॉमिक्स ही था।
अच्छा, और पॉजिटिव इकोनॉमिक्स, नॉर्मेटिव इकोनॉमिक्स ना। हां हां, ठीक है, हम लोग
सॉरी सर, यू आर नॉट ऑडिबल।
आई एम ऑडिबल, राइट? आई एम ऑडिबल। And just I will discuss in next class, okay? That positive mark.
ओके
Right.
सर।
Yeah. And next is Susmita Kumari. Do you have any doubt? Yeah. Susmita Kumari, if you have any doubt after this class.
गुड इवनिंग
Yeah, good evening, good evening.
सर। वो जो आपने अभी बताया टर्म डिसॉर्बल प्रॉपर्टी के बारे में, तो सर आप उसे एक बार समझा दीजिए प्लीज फिर से।
तो कौन से डिस्पोजेबल इनकम?
यस सर।
पर्सनल एंड डिस्पोजेबल इनकम, है ना?
यस सर, हाँ यस सर।
हाँ देखो बेटा, पर्सनल इनकम होता है हमारा खुद ही इनकम है, हम कहाँ काम कर रहे हैं वो उधर से सैलरी आ रहा है ना, कुछ भी कुछ नहीं सोच, लेबर दिया है, कुछ काम कर रहे हो उधर से आपको आ रहा है, वो ये पर्सनल इनकम है। ठीक है, अगर वो मिलने के बाद आप कुछ ना कुछ टैक्स पे करना पड़ता है गवर्नमेंट को, क्योंकि हम गवर्नमेंट से कुछ सर्विसेज ले रहे हैं, कुछ ना कुछ टैक्स देना पड़ता है। आफ्टर रिसीव द इनकम यू हैव टू पे द सम टैक्स, दैट टैक्स एक्सक्लूडिंग ना, सो आफ्टर reduce the tax, that is the disposable income, your disposable.
Okay, thank you so much sir.
Welcome Sushmita, welcome. Yuvraj, Mitra, yeah, you have doubt? Yeah, time is up. I think maybe you have another class also. Thank you. I hope you people are understanding the concept. Enjoy the class. Next class we will discuss on next. Okay. Thank you. Yeah. Yeah. Organizers, please close the class.